Welcome to the deep dive, where we turn complex research reports into, well, actionable insights for you.
That's right. And today we're really digging into the future of flight. We've got a deep dive on Archer Aviation, that's ticker ACHR.
Yeah, this is based on a pretty comprehensive stock research analysis. Our goal, extract the key takeaways, focusing on the fundamentals. Is urban air mobility really cleared for
And
takeoff?
we're anchoring everything to its closing price on September 23, 2025, which was $9.87 share.
Okay, so before we get into the weeds, let's maybe tease the big picture here. What's the core finding from all this research?
Well, the headline really is this. Investing in Archer right now. It isn't about traditional value investing. It's pure venture capital playing out in the public markets.
Venture capital, how so?
Because the potential is absolutely astronomical. We're talking market forecasts hitting over $1 trillion by 2040 for this UAM space. But the flip side is the risk of complete failure. It's just as massive. And what's really fascinating is our valuation analysis using, appropriate methods for this kind of company spits out this huge range. We're talking maybe $7.50 on the low end, up to $15 per share on the high end.
And the stock is at $9.87.
Exactly. Smack dab in the middle. The market is basically saying, okay, we see the trillion-dollar dream, but we also see the cliff edge. It's perfectly pricing in that huge uncertainty, a balance between immense potential and, frankly, catastrophic risks.
Boy, a real high wire act. Okay, let's break down how they actually plan to pull this off. Chapter 1, business understanding.
All right, so first off, Archer is an eVTOL company. That's electric vertical takeoff and landing. Think electric air taxis.
And the crucial point here is they're pre-revenue, like totally pre-revenue.
Completely. Their current valuation, which is what, $6.36 billion, it's entirely based on the belief they can execute their plan.
Which involves becoming an operator first, then a manufacturer.
That's the strategy. Long term, the main moneymaker is planned to be their urban air mobility network, basically an air taxi service. Think Ubercopter but electric, and priced, competitively with premium ride shares.
Okay, that's the primary stream. What else?
Second is direct aircraft sales, selling their eVTOLs directly to other operators, maybe airlines or private companies. That's the OEM model. And third, there's a really interesting non-cyclical angle, defense contracts. They're already working with the U.S. Air Force, which could provide a steady, less market-dependent income stream down the line.
Let's talk about the actual aircraft. The flagship is called Midnight. What are we looking at?
So Midnight is designed for short, quick trips across congested cities. It's piloted, carries 4 passengers, optimized for routes around 20 miles.
But it can go further?
Yeah, max range is about 100 miles, and it flies at 150 miles per hour. Pretty quick.
Right.
And the big technical proof point they already hit was with their demonstrator aircraft, the Maker.
Ah, the transition flight.
Exactly. That crucial transition flight. Going from hovering vertically like a helicopter, smoothly transitioning to flying forward on its wings like a plane, and then back to a vertical landing. That proved the core aerodynamic concept works.
Okay, tech demo is one thing, but building an actual business needs partners. You mentioned a big order book.
Yeah, it's substantial, nearly $6 billion, though it's indicative, meaning not all firm orders yet.
But the headline partner is huge.
Oh, absolutely. The agreement with United Airlines for potentially up to 200 aircraft, worth around $1.5 billion indicatively. Having a major airline like United on board, that's massive validation. It's not just about building a cool plane anymore. It's about integrating into the existing travel network.
And they need to actually build these planes. That's where Stellantis comes in.
Right. Their partnership with Stellantis, the huge automaker behind Chrysler, Fiat, Peugeot, is critical for manufacturing. They're building a high-volume facility in Covington, Georgia, designed to pump out up to 650 aircraft per year eventually.
So tech, partners, but maybe the biggest edge they have right now is on the regulatory front. The FAA hurdles are notoriously high.
This is arguably their most significant differentiator right now. You need this trifecta of FAA certifications to operate. Archer already has 2 of the 3 crucial ones.
Which ones are those?
They've secured Part 145, which allows them to perform maintenance on their own aircraft.
Yep.
And critically, Part 135.
Then Part 135 is the big one for operation.
That's the golden ticket. Part 135 is the air carrier certificate. It's what legally allows them to fly passengers for hire. It basically green lights their entire air taxi business model once they have the certified aircraft.
So the final piece of that puzzle is
type certification, getting the Midnight aircraft itself certified by the FAA as safe to fly. That's the last and arguably highest regulatory mountain to climb. Everyone's watching that one very closely.
Okay, so they seem to have a lead there. What about competition, like Joby Aviation? Is it a winner-take-all market?
Joby is definitely their closest peer. Their aircraft, the S4, has a bit more range, maybe 150 miles compared to Archer's 100.
Hmm.
But honestly, the potential market size here is just staggering.
How big are we talking?
Projections vary, obviously, but some see the UAM market hitting $92 billion annually by 2034. And long-term forecasts, Morgan Stanley and others have thrown out numbers over $1 trillion by 2040.
$1 trillion.
Yeah.
Wow.
So at least in the early days, it's less about cutthroat competition and more about proving the whole concept can work safely and profitably. There's potentially room for multiple winners if the market develops like people hope.
That massive potential absolutely requires the right leadership.
Let's move to Chapter 2, Management Evaluation. What's the story there?
It's sort of a classic tech startup structure, actually. You've got the visionary founder, Adam Goldstein. His background is more software and finance. He had a successful exit before Archer.
Okay, the ideas and money guy. Right. And he's paired with some serious aerospace heavyweights. The technical bench seems really deep. CTO Tom Muniz, Chief Engineer Dr. Jeff Bauer. Apparently, Dr. Bauer has worked on something like 5 other eVTOL programs before this.
So real domain expertise backing up the vision.
Exactly. You need both to tackle something this ambitious. But it hasn't been smooth sailing for management. They've had to fight some PR battles.
Ah, yes, the battle of narratives mentioned in the report. Short sellers have come after them pretty hard, right?
Oh, yeah. Firms like Grizzly Research, Culper Research, they published reports basically alleging that Archer's technology wasn't as advanced as claimed, or that their order book was, inflated smoke and mirrors.
How did management handle that?
Their response has been pretty straightforward. Strong denials, pointing to their tangible progress. Things like the independently verified transition flight, the actual FAA certificates they've secured, Parts 135 and 145 aren't just handed out, and the credibility of partners like United and Stellantis, plus their financials, which we'll get to. Basically, fighting claims with verifiable facts.
Makes sense. Okay, since they're pre-revenue, capital allocation is obviously crucial. Where's the money going?
It's all about getting to commercialization. So huge chunks are going into R&D, finalizing the midnight design, testing, certification costs.
Yeah.
Then there's the massive capital expenditure for building out that factory in Georgia.
Mm-hmm.
And they've also done some targeted M&A, like acquiring specific tech or maybe personnel, particularly to boost their defense program capabilities.
Mm-hmm.
It's all investment in the future product and infrastructure.
Now, this leads to some metrics that look pretty scary on the surface, like return on invested capital, ROIC.
Yeah, the ROIC number is jarring. It's negative 334%.
Right. It looks like a total disaster if you compare it to a normal, profitable company. But context is everything here. For a pre-revenue company building an entirely new type of aircraft and market from scratch, that negative ROIC isn't really a measure of failure.
So what is it measuring?
It's basically quantifying the sheer scale of the investment needed before any returns can even begin. It's the cost of building the foundation. You have to spend billions before you make a dime in aerospace, especially revolutionary aerospace. Think about early Tesla, early Amazon, massive upfront investment, and years of losses. That ROIC reflects the depth of the investment phase, betting on huge future payoffs.
Okay, that reframes it. It's the cost of entry for a potential revolution. Let's look closer at those costs and their financial footing. Chapter 3, Financial Analysis.
All right, the fundamentals. As we said, market cap around $6.36 billion, but the top line, well, there isn't one yet.
Zero revenue.
Zero total revenue recorded from 2020 right through 2024. And the losses are growing as spending ramps up. The operational loss in 2024 alone was about $509.7 million.
$500 million lost in a year. Yet the report talks about a fortress balance sheet. How does that square?
It squares because of how they've raised money. They've primarily used equity, not debt. Their debt-to-equity ratio is incredibly low, just 0.05, barely any debt.
Okay, so they're not leveraged up.
Not at all. And their short-term liquidity, it's phenomenal. The current ratio is 22.3.
22.3, that means?
It means they have over $22 in current assets, mostly cash, for every $1 of liabilities due within the next year. A massive cash cushion.
So that $500 million annual loss, they can sustain that for a while.
Exactly. They have the cash runway to fund operations through what's often called the Valley of Death, that period between initial investment and generating real sustainable revenue. That cash pile is probably their single most important financial strength right now. It buys them time to execute.
Which is vital because, as you said, traditional valuation metrics just don't work here. No PE ratio, no price to sales.
Completely meaningless when you have no earnings and no sales. Trying to use them would be nonsensical.
So how do you attempt to value a company like this? You mentioned a DCF earlier.
Yeah, the only tool that really fits is a discounted cash flow analysis. But you have to understand, it's highly speculative for Archer. You're projecting cash flows way out into the future, maybe starting significantly in the late 2020s or 2030s.
And those cash flows depend entirely on them succeeding with certification manufacturing operations.
Precisely. Huge uncertainties. So to account for that massive risk, the DCF model requires a very significant risk adjustment.
Which takes the form of a high discount rate.
Exactly. Because those future cash flows are so uncertain and so far away, you have to discount them back to present value using a much higher rate than you would for, say, a stable blue-chip company. For Archer, the analysis used a discount rate range of 20% to 25%.
20 to 25%, that's substantial.
It really is. And it reflects that extreme risk profile. It mathematically acknowledges the high probability that those projected billions in future cash flow might just never happen. It quantifies the venture capital nature of the investment.
That brings us neatly to how the broader market views this balance of risk and reward. Chapter 4, Market Sentiment.
And yeah, as you'd expect with a story like this, the market is really polarized. There are strong opinions on both sides.
Let's start with the bulls. What are the Wall Street analysts saying?
Analysts who cover the stock are, on average, pretty optimistic. The consensus rating is a moderate buy.
And price targets.
The average 12-month price target sits somewhere between $12.40 and $13.40. Compared to the $9.87 price we're anchored to, that implies, over 25% upside potential in the next year, according to the consensus.
Okay, so analysts see upside, but there's a significant group betting heavily against it, right? The short interest is high.
Very high. It's sitting at 17.09% of the float.
17%. How does that compare?
It's substantially higher than its main peer, Joby, which is around 11%. So yes, a significant chunk of the market, nearly a fifth of the freely traded shares, is being shorted. That means a lot of sophisticated investors are actively betting the price will go down. It confirms that strong bearish counter-narrative.
What about the technical chart picture? Does it lean one way or the other?
It's kind of sitting on the fence, reflecting that uncertainty. The stock price is currently just slightly below its 50-day moving average. That often suggests short-term momentum might be stalling a bit.
Longer term.
Longer term, it's still comfortably above its 200-day moving average, which was around $9.31. That typically indicates the underlying long-term trend is still considered bullish by technical analysts.
So short-term pause, long-term uptrend still intact.
Basically, yeah. The technical suggests the market is kind of waiting for the next big catalyst, likely news on FAA-type certification progress before making its next major move.
Okay, let's look at who actually owns the stock. Chapter 5, Ownership Structure.
This is another area that provides some interesting validation for the bulls. Institutional ownership is quite high.
How high?
Over 60% of the shares are held by institutions. That's a significant chunk.
And are these significant players?
Oh, yes. You've got the usual giants like BlackRock and Vanguard. You also have thematic investors like ARK Investment Management, who are obviously big believers in disruptive tech.
And the biggest institutional holder is actually a strategic partner.
Correct. Stellantis NV, their manufacturing partner, is the single largest institutional shareholder, owning over 9% of the company. That's a major vote of confidence from a company with deep automotive and manufacturing expertise.
Now, the report highlighted a really interesting contrast in insider activity. What's happening there?
Yeah, it's fascinating. On one hand, you see fairly consistent selling by some company officers, the CTO, the general counsel, people like that.
Which could look bad.
It could, but context matters again. These are often prearranged selling plans, 10b5-1 plans, for diversification. Executives have most of their wealth tied up in company stock. It's normal for them to cash out portions over time, regardless of their outlook.
Okay, so maybe not necessarily a negative signal, but what's the contrast?
The contrast is Stellantis. While insiders are doing planned selling, Stellantis has been consistently buying shares on the open market, actively increasing their investment beyond their initial stake.
So the key industrial partner is putting more skin in the game.
Exactly. That open market buying sends a very strong signal about their belief in the partnership and Archer's prospects, especially since they have an inside look at the manufacturing ramp-up.
Right, definitely adds weight to the bull case. Let's synthesize all these points now. Chapter 6, Risk Assessment. Let's use that SWOT framework: strengths, weaknesses, opportunities. threats to balance the picture. Start with the bull case, strengths and opportunities.
Okay, the core strengths really jump out. First, that $2 billion in liquidity. That cash runway is absolutely essential. Second, the integrated partnership ecosystem, specifically Stellantis for manufacturing and United for operations and demand. That's huge.
And the regulatory edge.
Yes, the FAA regulatory lead with Part 135 and Part 145 already secured. That puts them ahead of many competitors on the path to commercial operations. And finally, the sheer size of the opportunity, that potential trillion-dollar total addressable market, TAM. If they capture even a small slice, the upside is enormous.
So money, partners, regulatory head start, massive market. That's the bull thesis. Now the bear case. Weaknesses and threats. What are the big ones?
The risks are equally stark, and many are binary, meaning pass-fail. The absolute biggest is binary certification risk. If the FAA does not grant type certification for the Midnight aircraft, the whole enterprise basically collapses. Game over.
That's existential.
Completely. Second is extreme execution risk. Even with certification, going from prototypes to mass-producing hundreds of reliable aircraft per year and building out a safe, efficient, profitable air taxi network. That's an incredibly complex operational challenge that no one has truly solved at scale yet. Then there's intense competition. Yes, the market's big, but Joby and others are right there, and more entrants are coming. And finally, public acceptance. Safety is paramount. A single high-profile crash, even involving a competitor's eVTOL, could severely damage public trust and set the entire industry back years through tighter regulations or just fear.
What about broader economic factors?
It's definitely vulnerable there.
High interest rates are a killer for companies burning cash and relying on future profits. It raises their cost of capital and makes investors less patient with speculative, long-duration assets like Archer and supply chains.
Big potential bottlenecks, especially for things like advanced batteries, rare earth minerals needed for electric motors. Any significant disruption in those global supply chains could severely hamper their ability to scale production, even if everything else goes right.
Okay, a clear picture of the high stakes. Let's bring it all together. Chapter 7, conclusion. Let's summarize the core arguments again, that high-risk, high-reward dynamic.
Sure. The bull case is essentially, Archer has the necessary ingredients, the cash, the key partners like Stellantis and United, a crucial head start with FAA operational certificates, and they're targeting a potentially revolutionary trillion-dollar market. They're positioned to win.
And the bear case.
So bear case fires back. There's still just a concept with zero revenue. Everything hinges on two massive ifs, achieving FAA-type certification and then flawlessly executing an incredibly complex manufacturing and operational scale-up. Failure on either front is likely fatal for the company as an investment. Plus, competition and macro risks loom large.
So given all that, you ran the numbers using that highly speculative DCF model, factoring in the huge uncertainty with that high discount rate. What was the final estimated intrinsic value range again?
After accounting for that significant risk, the model produced a very wide estimated intrinsic value range, somewhere between $7.50 and $15 per share.
And the stock, as of September 23, 2025, was trading right in the middle of that range at $9.87.
Exactly. The market price is sitting squarely within that uncertainty band. It's not pricing in guaranteed success nor guaranteed failure. It's pricing in the probability of both.
So the takeaway for someone looking at Archer stock today is...
It's that this is not a traditional investment. It's a bet on near-perfect execution in creating and dominating a brand new, potentially transformative industry. High risk, high potential reward, and the current price reflects that tension perfectly.
Got it. Before we wrap up, you had one final provocative thought for us.
Yeah, just something to consider about the global picture. Archer's made great strides with the FAA here in the U.S., which is fantastic. But this eVTOL race is global.
Right, China, Europe.
Exactly. And what happens if, due to geopolitical competition or just different safety philosophies, other major markets, think Europe C8, or regulators in Asia, develop significantly divergent regulatory standards from the FAA?
Meaning FAA certification might not be enough to operate globally?
Potentially. Archer might find themselves needing to conduct expensive, time-consuming parallel certification campaigns just to get the Midnight approved for sale or operation in those other massive urban markets. It adds another layer of complexity and cost to their global expansion plans, even if they succeed in the U.S. Something to keep an eye on.
A really important point about the global regulatory landscape. Okay, that wraps up our deep dive on Archer Aviation. Hope you found this breakdown useful. If you did, please like this and subscribe to Stock Analytics AI.
And remember, for just €4.99 a month, members get priority access to our deep dives. We're planning to cover all the S&P 500 stocks over the next few months, so members get first crack at those.
Or if you just want a specific company covered, drop us a super thanks with your request, and we'll see what we can do.
Thanks for tuning in.
Until next time, keep digging into the details.
And the important reminder, this analysis was generated by an AI system. It's for educational and informational purposes only. Definitely not financial advice. Always do your own research before making any investment decisions.